Welcome to this episode of The Complete Advisor. We are here. We are going to talk about an opportunity with life insurance that a lot of people, a lot of advisors don't take advantage of. One of the reasons I think, as a former advisor, of course, take my word for what it's worth because I'm on this side of the table now. I know that it's a whole heck of a lot easier and maybe more interesting for a lot of advisors to rebalance portfolios and look at investments and work out those retirement plans and how are we doing this versus let's talk about life insurance. And life insurance is perhaps maybe one of the most amazing vehicles that's out there. There's only one problem with it, and that's that you can have all the money in the world, but you still have to qualify for it.
That's right.
Your health. Okay, so on today's episode, here's what we're going to do. We are joined by Adam Gulin, and we are going to talk about, it's a weird-sounding word. It is the word LIRP, which stands for, and I had to do a little reading because I had to bone up just a little bit. So we're going to talk our way through the life insurance retirement plan, what it is, why you should look at it, where it fits, maybe where it doesn't fit, because there is that's one thing in this world is everything has a pro and a con. So we're going to walk through the pros and the cons. I got a list too, so you're.
That's great.
That you haven't even seen. Okay, so Adam,
I'm flying blind.
You are. You agreed to walk into this thing.
I did.
So let's talk a little bit about you. Let's talk about your bona fides. So you're down in Texas.
Yep, mostly in Texas now. I dabble around in different states, but mostly San Antonio, Temple area, Central Texas.
Nice. And you've got a background when it comes to retirement planning, including life insurance.
42 years, yes.
42 years. Seen a thing or two come around. I
started selling Medicare supplements in 1982 in Austin, Texas.
Nice. Keep Austin.
And I evolved.
Nice. Yes. Okay, well let's just dive right in. So for those people that have never heard the word LIRP, define it. What are we talking about?
Very simple. It's just an advanced strategy to do a triple header concept that people can't normally do on their own.
Okay.
So number one, the tax-free income side of it is a big deal, but at the same time what you're doing is you're mitigating a long-term tax problem by showing the RMDs, and then you show, like I do, a 10-year plan which pays the taxes off mostly on qualified plans. And the way you lay it out is you take a gross amount out. So let's say they have $1 million. Mm-hmm. So without adding interest in it, make it easy. You take $100,000 out each year. You're going to pay the tax on that, roughly $22,000. You're going to fund the LIRP, say $25,000. You're going to convert the rest to a Roth or do a split between spending and Roth. So when I showed this concept and I add that much extra money to it and I add the benefit of, and by the way, if you predecease this, your wife's going to get $600,000 and by tax-free. And by the way, how would you feel if I could get you long-term care for nothing? They always say yes.
I would say yes to that. However, there's a whole hell of a lot to unpack right there.
That's right.
All right, so let's take a step back. So you have just, boom, dropped the knowledge bomb on us, but let's take a step back. So a LIRP, let's level set, let's define a couple things here. So one of the beauties of life insurance, of course, is that if you pass away, that benefit goes to your beneficiary.
Tax-free?
Tax-free. It's a beautiful thing. Another benefit that's available to you with life insurance products, if it's a cash value policy, if it's got cash value in it, is the ability to access some of those funds using different methods, right?
That's right. And what it is a non-recourse note. Congress wrote the law to specifically help themselves and the CEOs in America, which now we can take advantage of.
Sure.
And so by using the non-recourse note, meaning you're borrowing your own money, and that's in the IRS code. Because you're doing that, you have all this tax-free income coming in. My average client's going to make between $28,000 and $38,000 tax-free a year, starting in year 11.
So we've got we're using with the LIRP, we're using a life insurance product.
Yep.
Clearly, it needs to be a cash value product.
Yeah, it really needs to be a universal life, an indexed universal life. It works the best.
Okay.
Yep.
But you could do it with any permanent?
You can, but it's more complicated to do it with any. You want flexibility.
Sure. Okay.
Because what if 1 year you can't make the premium, or what if you want to just pay half? it's kind of hard to do that with a traditional whole life product versus an indexed universal life policy.
Okay, so you can do it with permanent, but there is a preferred type. So we've got the opportunity with this little rascal called LIRP using life insurance to really benefit someone's retirement plan. So when we start the conversation, who would be the ideal person for this? Before we get into the mechanics of how we do this thing, who are we looking at here?
Okay. We're looking at someone with about 200,000 and above qualified assets that they don't need anytime soon.
And when you say qualified, just for clarity,
401k, 403b, 457.
Okay, so a qualified
or an IRA.
Qualified money.
Yeah, right.
Okay, keep going.
So it's typically going to fit very well if you have $200,000 or more. And you understand that the positioning is you make them do the rule of 72. The rule of 72 is how fast does money double. So as an example, I have people that have plenty of income from pensions and Social Security. So I have this $250,000, let's say TSP in the federal system, and they're not going to need it for 10, 11 years. So what I'm going to tell them is if you're looking at your C fund, you're averaging 13% a year in your C fund. That means your money doubles every 6.5 years. And I said, so how much is that, Mr. Jones? Well, that's $400,000. I say, so is the government going to want more at $200,000 or $400,000? Well, $400,000. And then if it goes to $800,000, how much more money are they going to want? So you effectively are going to hand over about 40% of all this qualified money if you don't do something about it. And that's why we're talking today, because we want to set out a tax plan that's going to be very viable and work for you. So that's why we're going to talk this through very comprehensively. And actually, I don't talk it through comprehensively. I talk about three things. I talk about tax-free income, I talk about death benefit, and I talk about chronic illness rider.
So you have kind of a live die, or things don't go great.
And what I find is the less I get in the weeds and explain every single thing, the better off it goes, and they're ready to take an application. The key is not to ask for any money up front. It's soft selling it and saying, here's what we're going to do. I want to find out if my prediction on what it would look like is going to come true. In order to do that, we need to get some medical records to do that. So let me ask you a question up front. How's your health? And I just start asking them questions. But that happens after I've identified the problem. And I identify the problem by saying, okay, you've got this much money. And most people have more than 200. So let's say they have 400. And I say, you're not going to need to access that anytime soon. But do you understand that this is a ticking tax time bomb for you? And usually they will start to come around and not understand. And I really get into what is your base expense in retirement? What is your number one expense? They say everything. They say food, electricity. Blah. I say, nope, it's your taxes. Your tax is going to be the ticking time bomb that's going to blow your financial plan up. Would you like to defuse it? And they always say yes. So when I get past the minutia, which is about 5 to 10 minutes, that's it. I say, here's what we're going to do. I have the proposal here. We think you're going to get this much death benefit, and we think the tax-free income is going to look like this, and we think the non-recourse loans, and I explain that it's a loan that they don't need to pay back, is going to look like this. I want to get your signature, and we're going to hold a phone interview with you to go through your medical issues, and we're going to send a nurse out to take your blood and your urine and make sure that what I'm telling the company is true. And you won't have to pay a dime for this. Are you okay with that? They always say yes. Let me tell you something. They take the app, they're buying it. And they always take the app.
Nice.
I think I've had 1 out of 50 say no.
So does this tend to be more of a, do you see this more as a play for somebody that would be high net worth or has significant retirement assets, or is this something that somebody that's younger can start earlier?
Somebody, I have quite a few people, 45, 50, that they have discretionary money, $1,000, $1,500 a month. I figure it all out, and we start their LIRP early, and we just put it into that if they have that extra money. But I make sure that I identify that they actually have enough extra money to pay that monthly premium, but they all love it.
Yeah.
They love what it's going to do for them in the future.
Now, do you see people using this as a supplement for their retirement plan,
Absolutely.
or do they use it instead of?
Mostly as a supplement. Yeah. So they don't know how to get the money out of there. They don't know how to mitigate their taxes. I ask people, would you rather, look, here's your RMD table. Let's say your taxes are $1 million, after we calculate it all up. And over here, I'm showing you a way you're only going to spend $340,000. So logically, what's your answer? Okay, you want to do this, but we got to qualify you.
Yeah.
To get this, I'm starting to take away right there. They will sign it in a heartbeat if you take it away. Mm-hmm. Say, I don't know if you can get this, but if you can, that makes your world a lot different than the way you were going to go about it. And you know what they all say? They say, I was kind of thinking this, but I didn't know where to go or who to ask. My CPA just said, just do a Roth conversion. Mm-hmm. Well, that can work, but it doesn't give you all of the benefits that a LIRP would give you. You're going to use a Roth in conjunction with the LIRP, not as the sole item.
All right. Let me. So I want to run down. I want to run through the pros and the cons here,
Sure.
and you get your commentary as I run through this. So this is from an article I was reading. Pro, tax-free income in retirement.
Yep.
Given, right? Tax-free death benefit for beneficiaries.
Yep.
We've got no contribution limits.
Right.
And let's see, no RMDs given there.
That's a big one.
Yeah.
The fact that the IRS is not forcing you to take the money out. So if you don't want to take the money out, you can leave it. And all that's going to do is push the death benefit up so it doesn't mech the policy.
Define that.
Modified endowment contract is a IRS term saying that if a life insurance cash value gets above a certain threshold against the death benefit, it becomes a taxable investment.
Gotcha.
Yep.
Was there like a 7-year rule or something with that, or am I misthinking here?
There is. That gets more complicated, and it's much more.
All right, we'll stay out of those weeds.
That's a lot. That's some big weeds right there.
All right. Well then, okay. So there's the pros, and one thing that I know, we know that term. There's no such thing as a free lunch, and everything has something. Okay. So some of the cons that this was listing was higher premiums and fees.
Fees are going to come in right around 1% a year net.
Oh.
Now, they're going to get front-loaded mostly, and then they're going to have a small back end, which is more complementary to them, because if they have a small back end load, each year for administrative cost, then the compounding effect works better. So if we front-load everything, so there's usually no cash value, let's say, for the first 3 years, because they front-loaded everything. Now they start building cash value, and the expenses go down as the years go by. Mm-hmm. So they're getting the benefit later, which is actually, when you examine it, it looks really, really attractive.
Yeah. So I can see that as a con. If you I could put money here, I could put money here.
Yep.
If I do that, I see that early.
Sure.
Okay, so that would be one. Okay, somebody put this in as a con. Maybe they were looking to match up, but not a standalone retirement solution.
Not at all.
Yeah.
Not at all. It's part of a complete plan. The issue, I think, where reps get in a problem is they're not trying to be a complete planner. Mm-hmm. When you're trying to just sell it, it goes against really what their thinking is. But if you come in with, here's what we're going to do. We're going to have this emergency fund. We're going to have your growth plan here so that you can take your cruises. We're going to have an estate plan. We're going to have a tax plan, which includes the LIRP. And we're going to wrap this up in a nice, neat little bow, and it's about 5 pages long.
Yeah, I imagine that's one of those things that they're not a standalone. Where if somebody only has a hammer, everything looks like a nail.
Yeah. It would be a mistake to try to just do this exclusively without doing a plan. And doing a plan is not going to be hard. If you use the retirement analyzer, then tie in the Stonewood product to show the benefits of this, you've got your plan done.
There you go. Since you dropped 2 names there, I'm going to expand. So Retirement Analyzer is an amazing resource, a great tool. We have it here available for our advisors from Creative One.
That's right.
And reps, you can use it. Insurance agents, et cetera. It is a great software. They've been a national company for years. And then Stonewood, we just had the course in. In fact, we had Becky Swansberg in the podcast room.
We did, and I'm going to take great advantage of. They have some really, really, really good tools, and they can be doing a webinar for me with me just introducing them and them speaking while I'm actually doing a live presentation somewhere. I'm excited about this.
They do, their approach to really bringing taxes up to a risk category and looking at that and the way they approach it, they've got an amazing book. They're great. Okay, so not a standalone solution. LIRP con. Withdrawals and unpaid loans reduce the death benefit.
That's true, so what I try to do is really lock down the client and understand that they're not going to need this money. Things happen, life happens, and there is some liquidity if they need it, but it destroys their entire plan.
Yeah.
However, 98% of the time, you're not going to have to worry about it. They're going to make the premiums on time. I'm in year 3 with some people right now. They're making these $45,000, $50,000 premiums, and they're not having a problem. And they're taking it out of their 401k, paying the tax, paying the LIRP, converting some of it over to a Roth. They're happy as can be.
Nice. Okay, so and then another potential, kind of a con/danger, potential for policy lapse if cash values drop below a certain minimum.
Yeah, that's true. And I think that common sense would tell them if they don't pay for it, then they're not going to keep it. I think that we would have to worry about that if we're trying to squeeze a LIRP into somebody that shouldn't be in one.
Yeah, it comes down to suitability.
Yep.
Yeah, making sure that
I think that if you get rid of the greed, and because the LIRPs pay you a big commission, okay? But if you get honest with them, like I turned down somebody last week, had about $125,000 of qualified money, and I said and a nice pension and Social Security, but I said, based on the numbers, I can see the possibility that we would get in trouble at some point if you had a big expense. You're not going to want to pay the premium that year, and I talked them out of it.
That's good. We have to. You
got to be honest about it.
Yep. Give the right advice. Last con they had listed substantial amount of cash value needed to generate tax-free income.
Yeah. Well, it is, but that's the idea. By using 10 years, you're going to compound the effectiveness. So let's say that we use the S&P index. We're compounding an index. I just look at them and I say, okay, so we can't show you anything beyond 5% because of the NAIC. However, do you believe that's all you're going to make? And they go, no, I don't believe that. I said, that's all I can tell you.
Yeah. I guess really it is an awesome opportunity to add to it to a person's retirement planning and really to their retirement success. What advice would you give to an advisor who's listening to this who has not presented it before? Where should they start on Where should they start on educating themselves, and then some tips you have for them?
I think they need to call right here.
Like that.
And I think they need to talk to the life team. Anybody on the life team can get them started, and then ask to take a look at the Stonewood product and start studying it, because it will clear it up really quick. I'd say somebody could really get on board in a day by reading the Stonewood product.
Right.
How it works, looking at the presentation, asking to see a presentation, and it's quick and easy and fundamentally understandable. Here's where the problem lies. Too much detail. If you are a detail-itis person that loves to spreadsheet your clients to death, I would not recommend you go here, because you're going to lose yourself in the weeds, aside from your client. If you're an engineer type and this is what you have to do, they have the tools that you can do that with. But I'm going to tell you right now, 95% of your clients aren't going to want to go through that.
It is the classic. If you've never heard this one before, I didn't come up with it, but people want to know what time it is. They don't want to know how the watch.
How
is
do
made.
you get there? That's right.
I don't want to walk back into the kitchen of my favorite restaurant. I just send out.
They
my
just
burrito.
want to. It's going to come down to trust, and I think that I really do think if you give too much information, you start to sound untrustworthy because you're having to sell the information rather than the concept. It's the concept that will do it. If you give them too much information, they're going to be sitting there, I think, in my 42 years experience, they're going to be saying, I wonder why he's telling me all this. I don't even understand what he's saying. I just want to know, does it work? That's what most people are thinking.
Yeah, you can on-sell something pretty quick.
That's right.
Okay, so any Any learning lessons you've made selling this? Any crash and burn stories?
Yeah, bringing it up too fast. And people would come in and immediately jump on the tax instead of slow walking it. I'm telling you, do not present it up front.
Yeah.
Start with cash flow and liquidity and growth factors, and then go in. So I have a chart that it says cash flow, liquidity, growth factors, tax plan, estate plan. So I go through each one of those, which that means when I get to the tax plan, I say, I'm going to come back to that last because that's going to be a big topic that we're going to work on because I hate to say this, Frank, but if you do this formula, just write this down right now, the rule of 72. If you look at what's in there and you take a look at what the historical averages are, let's say it's 6%, you're going to double that money every 9 years. You can see you're going to get into a tax problem real quick. I'm going to show you how to mitigate that, but not today. And then the estate plan, I'm going to tell you the difference between a will and trust. And based on your assets, and you've got 2 marriages and everything, we're going to talk about probably doing a trust. But in the meantime, let's go back to cash flow.
Yep. It is real easy to, you can get too excited.
That's what I did, and I blew it.
Yep.
I blew it on 2 people. I knew what I did. I did everything I can not to beat myself up, but I did beat myself up for about a week, and then I said, okay, not going to do you any good to beat yourself up. Move on. Just don't do it again. And I've had success ever since I've been doing that.
Nice.
Yep.
All right. So with that being said, the LIRP, something you as an advisor should be considering. Who should not consider it besides somebody who wants to get way into a weeds? That's kind of a given. But
well, if you're just an annuity-only salesperson, I think you're going to get yourself in trouble. If you're just a security salesperson, I think it's somebody that does both sides. It's got your fiduciary. You've got both sides of the aisle. You have your securities license and insurance license, and this is right in the middle. Okay, because this is almost a hybrid between the two. Almost a hybrid.
Nice.
Yep.
All right, so with that being said, I'm going to thank you for being here. Thank you for walking us through and talking about LIRPs. First time we talked about it on the podcast. So.
Well, I will tell you, I have to give credit where credit's due. We have a guy here named Mark Fricks. He's in Atlanta. If he hadn't taught me this, I wouldn't be where I'm at with it today.
He is an awesome advisor and also a stand-up comedian who is actually funny.
I love him to death. He's like a brother to me.
He's a good guy.
Yep.
All right, well, so here's what we're going to do. We are going to wrap this episode of The Complete Advisor. I thank you for being here. I thank you for being here out there in listener land. And I'll tell you this, don't forget, of course, love it if you'd like and subscribe. And if you have any comments, feel free to put them in there. I love looking at them. Suggestions for episodes, etc., etc. We will see you on the next episode. Thank you.
It's great being here.